Very quickly on to Sandip Sabharwal. He joins us this morning for his perspective with regard to markets. Sandeep, earnings now firmly behind us. How would you assess the overall earnings picture, the scorecard?
I believe the overall earnings season went off well with a majority of companies meeting or exceeding expectations. There are some extraordinaries which many companies had because of inventory gains, because many input prices or finished good prices also moved up substantially during the month, and as such, there was an extraordinary element of the profits also. But even adjusted for that, the result season was fine, and the overall outlook for the rest of the year also continues to be reasonably strong. The only thing I've reiterated many times in the last few weeks is that for India, the biggest macro concern remains higher oil prices and commodity prices led inflation. And with the Middle East conflict still continuing, despite a very weak US dollar overall globally, the US dollar index has weakened significantly again. We are not seeing that momentum in India because in India, the crude oil concerns continue to dominate and its impact on the macros.
Sandeep, just for the purpose of headline, today obviously the biggest one is the fact that you've got the ECMS scheme approval, and it's a decent size in terms of the approval that's come through. Multiple companies across a range of sectors will benefit, but largely it's EMS, right? That's really the theme at play. Would you go out and buy any EMS players, or would you find them expensive with probably multiple years of earnings already factored into stock price? How would you look at them?
I'll opt for option B.
Okay, got it. But Sandeep, if you were to pick one, would you still avoid at this point of time? Would you wait for a correction?
I think what people need to analyze is that the entire EMS industry operates on very thin margins. They are at the mercy of many of their clients, and to a large extent, they also rely on government incentives for their profitability. And many analysts get excited when companies announce large capex. A large capex does not mean immediate turnover and profits out of that. So I think many analysts have a very small history of where they have analyzed publicly limited companies. If you go back 20, 30 years, you have seen that when small companies undertake very large capex, many times it leads to unwieldy balance sheets, losses, etc. also, because just setting up a capacity does not mean you're going to make profits out of it. You can make a loss out of it also if there's overcapacity. I think all those things need to be adjusted into valuations. EMS as a business trading at 70, 80 P is not justified by any parameter.
Taken. Kunal, though, let me come to you on the charts. Anything that's looking attractive from within that EMS basket for a fresh trade at this point in time?
Not really, Harsh. In fact, many of these stocks have actually, come back in towards some bit of volatility, some bit of, price. I would say oversold, overbought nature in terms of price indicators, and the risk reward is not attractive for many of these stocks. For example, look at Jyotin CNC. That stock moved up towards, I think, around 880, 890 mark. And then there was a sharp correction, I think a 10% odd correction, where the stock on a single day went through a sharp round of volatility. Same is the case with, Sirma SGS and the other names. My sense is that I think the space is getting a little bit more volatile. So it's better to try and wait for this period of volatility to ebb off and then try and chip into the space.
Let me go straight back to Sandeep. Sandeep, yesterday, and we know you to be candid, and therefore I'll ask you specifically on a stock called Zaggle. The stock was down 20%. It's now back to the September 2023 level in terms of the stock price. You had a couple of months back, the promoter coming in and saying he is going to buy a stake, but you still saw extreme weakness in terms of the numbers. They explained that weakness also on the con call, suggesting that it was certain expenses within a single vertical which were recognized, but revenue not recognized. You've seen multiple cycles, multiple stocks. I don't know if you have a view on this one, but if you don't have a specific view, what would you advise viewers who are holding the stock?
I didn't track this company closely because the business it isn't did not excite me, you know. But I think these kind of mishaps sort of should be a wake up call for many investors who just focus on reported P&L numbers without looking at the balance sheet deterioration possibility, like growth in receivables. Uh, and there are so many other parameters which need to be looked at before we assign valuation multiples to companies, because uh, if the balance sheet does not cope up with the reported numbers, that at some stage that adjustment tends to happen. So I think that's all I'll comment on, and I think we'll see this happen in a few other companies also.
That's the take coming in on what one is seeing in terms of those wild moves with Sagal yesterday. The renewable energy theme definitely sprung up quite a fair bit yesterday. Inox Wind, Suzlon, these were two names which also looked good. Kunal, any trading opportunity here?
See, I think Inox Wind could be something to be looked at purely from a trading perspective, because I think this range of 70 to 75 approximately has been acting as a good support range for Inox Wind. The stock seems to be coming back, tapping back into this territory and then seeing a bounce back every time. Of course, the stock is very high beta in nature, but so the risk reward has to be a little bit skewed. But I would sense that this zone of 70 to 75 could be a good territory where traders could look at accumulating the stock. On the higher side, I would look at 82 to 85 as a near-term target range, which could be a decent 10% swing range for Inox Wind, even if it's a short-term trading play.
I just want to check in on Paytm as well. That, of course, is going to be one key stock to look out for too. We just flagged off that there has been capital raising all across, and it's not just Paytm. Many other block deals like Snehi just flagged off. But it seems that there is a block deal of up to almost 5% equity stake. The deal value, of course, is going to be roughly about 4,900 crore rupees. And ANFIN transfers to Resilient now. Remember, the RBI had required that ownership and control structure to remain India-centric, and Resilient got that legal ownership and voting rights over the shares as well. ANFIN then had retained the shares' economic value through convertible debentures, and they changed the control without making a complete economic exit. The stake sale, of course, is going to be monetizing part of this economically retained value for ANFIN. But Sandip, curious to know, how are you reading into this mega block deal of Paytm?
I think it's a massive supply because it's almost 5% of the equity of the company. So obviously there'll be some impact on the stock price, and it's timed sort of perfectly for the sellers because it's at 52-week high, and I think a multi-year high also for the stock. So I think for the sellers it's good. For the buyers, they have to consider the valuations, which seem extremely stretched, and we've seen a decent run up in the stock after the new MDR introduction possibilities, etc., came up, and so that's also getting built into the valuations now. Whether that will come, how much that will come, also is uncertain. I think it's buyers beware at this price.
Just the quantum of fresh paper which is coming, whether it's IPOs, whether it's blocks, or whether it's QIPs, it looks difficult for our markets to make moves with this kind of fresh paper, right?
Yeah, so on one side, you have the macro concerns related to the Middle East. On the other side, you have these kind of huge supplies. For example, I think the IPOs for this week itself are from 6,400 crores worth. Then you have this large block deal. Then new block deals keep on getting announced almost on a daily basis. Plus, the government also is on active disinvestment spree this year with regular announcements of offer for sales. So I think there's just too much supply in the system. And that is the biggest problem facing the Indian markets today. Because if the macro concerns are not there, then I think we could still have got absorbed these. But with whatever is happening around the globe, these kind of supplies are very, very tough to absorb, especially in a scenario where the net inflows into equity mutual funds also have started to moderate somewhat.
Okay. Sandeep, any fresh ideas post the earnings that you're considering actively at this point in time?
No, nothing new per se. So I think on the large cap side, there are companies I think which can still deliver decent results. For example, something like L&T, which has underperformed due to Middle East concerns, but they've been winning huge amount of orders. Something like a Bharti Airtel, where there seems to be a clear move towards higher tariffs now, and Bharti obviously is a clear beneficiary of that, along with the other players also. So I think these couple of companies, I would think, stand out, which could possibly still deliver double-digit returns.
Right. Sandeep, a renewed vigor once again when it came to some of the capital market themes. We were talking about K-Fintech, Motilal Oswal held out very well, NAM India looked also very good. Are you broadening the pool at all within capital markets?
In the capital market plays, I think the space I like for very long term are the asset management companies, because those have annuity incomes and as such uh, keep on growing, and I think they'll keep on growing for the next 10, 15 years also. I don't like so much of the transaction oriented companies like brokerages, etc., because transactions can be volatile and then market shares can shift, etc. Whereas the annuity income for asset manager tends to be more durable. I think that's the space people should look at. Right now, the valuations are not very attractive in that space also, but for a very long-term horizon, they could still be okay. And that's the space people should look for in corrections.
Interesting. Okay, Sandeep, stay with us. Just going to address this one very critical news coming in this morning. The fact. Back with the market right here in ET Now. Let's just revisit what the GIFT Nifty is settling in at, given the fact that you are seeing crude spiral up once again to over that $91 per barrel mark, currently lower by 112 is where the GIFT Nifty is, 24,280 thereabouts. Having said that, we've been just in that range for many months now, and Kunal, doesn't seem like we're snapping out of this range in any hurry, either on the upside or downside.
Yeah, it doesn't look like, and with this addition of new data points which are impacting the markets every now and then, whether it's with respect to crude oil prices, earlier it was dollar index which was hovering around 101 mark. I think it's acting as a more of a ceiling or a resistance or a supply point for the markets at higher levels, and that's actually the reason the markets are getting capped into. Over the last, I think, 2 weeks or so, the index tried to attempt towards a break of the 200 moving average, but we failed to cross over that on the Nifty. Even the Bank Nifty, which was trading above the 200 moving average, I think with today's price cut, we could be at the cusp of a break below those averages. So that could probably also dampen the market or the index charts over the very near term.
Well, talking about the new paper hitting the market, Sandeep, you've not subscribed to any of these IPOs of late, have you?
No, because I think the valuations of most of them are very high. Some of them tend to get listed well. Like, for example, Manipal had a good listing, but then again, trades at 90, 95 times earnings. So very tough to justify these valuations. So initially, I think in many of these IPOs, because the supply is so constrained, thus sometimes the IPOs tend to do well. But then eventually the valuations tend to catch up. So I think I find it very tough to justify investing in most of the IPOs.
Well, auto anchs, that's the other space which has been extremely exuberant and buoyant in the markets of late. I was just reading somewhere this morning that apparently two-wheelers, EV two-wheelers have a waiting period of almost 4 weeks, and that never happened in the history itself. So indicative of the kind of demand that one is also seeing. And yes, auto anchs, OEMs, whatever you may want to call them, that entire space is looking extremely buoyant along with that. And we've seen that in the numbers. I mean, be it from a TVS or a Bajaj Auto, big beats from both these companies. And the indication is that the demand as we step into the festive season, which is going to be a little later as well in the next quarter, that also seems to be buoyant itself. But Sandeep, the run-up has been very steep, be it in auto anchs or two-wheelers in specific. What do you do now? Just wait for that dip whenever it happens?
Yeah, because I think there's momentum in the sector. Two-wheelers especially, I think will continue to do well, both due to buoyant rural sentiment as well as the uh, inroads EVs are making on the two-wheeler side. And as I've just said over the last many months, that it's a sort of shift in technology. And when that shift happens, sometimes the demand tends to surprise most analysts because uh, people are moving away from the traditional petrol bikes to EVs. And I think that acceleration will only gain steam over, and I think two-wheelers in India largely will become EVs over the next 10 years, I would think. So I think that's how we should see this space. So I would agree with you that it's a sector which is buy on dips. Auto ancillaries also are doing well, both due to domestic demand, and many of them are export plays also. Some of them are doing well due to exports also. So the overall space, I think, is a reasonably good space with valuations in some pockets slightly stretched, but overall still fine relative to the market.
Kunal, any trading opportunities, autos, auto anchs across the board?
Yeah, quite a few, Aisha. So I think even the battery makers, for example, the likes of Exide and Amara Raja Energy and Mobility, I think that stock, both these stocks are looking quite charged up. And in fact, over the last 2 odd months, these stocks have managed to give somewhere around 15 to 20% from 400 or sub 400 levels to 480 thereabouts for Exide, from 900 or 875 thereabouts to 1000 plus very recently for Amara Raja. I think these stocks have done reasonably well. Sunam Comstar is something which you've been highlighting over the last few weeks and months. I think that stock continues to look attractive, especially with the kind of a breakout the stock is poising towards the monthly and the quarterly charts. That's very, very attractive on the longer term basis. Then the likes of Craftsman Auto, etc. These stocks have done phenomenally well on the long term basis. Been more of a consistent mover over the last 1.5 odd year, even at a point where many of these auto stocks, the traditional auto OEMs, they were struggling. And then the very recent breakout, which was then the auto Ank pack, was some of the Motherson. That stock breaking past about 145, 150 barrier, which has been a huge resistance for the stock over the long term.
Sandeep, the other one that was in focus at least yesterday was a Uflex. Uh, packaging companies have done relatively well. I mean, just given the fact that you've got raw material prices which have spiked, you've got select packaging companies which have actually done well. Is this a space which you're looking actively at, or I mean, it's a niche one, but
The packaging sector, if you have tracked them for the long term, you'll see that they tend to have significant volatility in their performance. So I think uh, 1 or 2 years, these companies see very strong profits when demand supply imbalance is there. Then huge capacities come up because setting up capacity is not so expensive, and then many of these companies actually go into losses. So it's a very tough sector to invest in. You need to track them very carefully when it's in a downturn, invest in them, and then you can make money. So I think right now it's already in upturn. We've seen strong results from other companies like Polyplex, etc. But then these stocks tend to run up uh, much earlier than we can possibly track them. So I don't know where exactly the cycle will go, but my history of tracking this sector is that they are very fast upturn and downturn cycles.
No, point well taken. I wonder, Kunal, consumption as a bucket, how should one play it at this point?
See, I would believe most of the stocks are still struggling. I think from the consumption pack, you look at, so I'm talking of the traditional FMCG names, the likes of Nestle, Britannia, Dabur, Marico. I think the best suited scenario for them is just to try and play a very minor range of consolidation. If you're looking at, say, a 2% to max 5% swing into the stock prices, only then it makes good sense to try and chip into these names. The only positive part when we look at for the FMCG pack is the lack of volatility for the stock prices, largely on a larger basis, except of course for the likes of events like news flows around results, etc., where the stocks could be volatile. But largely, I think these stocks have exhibited lower degree of volatility. Most of the stocks are going towards a corrective phase. Even now, HUL, for example, is a stock which is still trading below the long-term moving averages. So is the case with the likes of Dabur, etc. So majority of the stocks are trending into a lower degree trend for themselves on the long-term charts. But it's just that every now and then these stocks show a very strong propensity for a 3% to 5% odd bounce where traders could try and participate.
Oberoi Realty is the other one which is going to be in focus. Their project 360 North in Gurugram, there's an update there. The Haryana DDCP has rejected a petition against Oberoi Realty, and that, will get treated perhaps as a big overhang lifted. Having said that, Oberoi Realty has been moving from strength to strength in the last 2 weeks at least. Another 5% of a dash is what you had on the stock yesterday as well. And then just scaling back to yesterday, Purvankara came out with an excellent set of numbers too. Sandip, any fresh ideas within realty and whether that's a sector you're looking at also right now?
So realty is a sector which is somewhat in the middling phase where the sector had a strong sell-off when companies came out with decent results. So we've seen a bounce back. So I would think that could be a sector which could be interesting on corrections only. Uh, the prices have stopped moving up, so I think that's there. But sales momentum in terms of pre-sales still seems to be there. While many of the companies also are cautioning and not launching new projects. So I think it's a space which is not on a clear upturn. So I think we have to wait for corrections.
You've got one of the blocks of Paytm coming through. Around 1.92 crore shares have exchanged hands. Still some way to go for that complete block to come through. 3% is done for the moment, is the confirmation we're getting. 1% higher in pre-open nonetheless on Paytm. Sandip, any of the platform companies interesting you at all?
Again, I think it's the main issue is valuations. So right now, valuations seem excessive.
Okay, so typically you stay away at a point like this.
Yes, because I think many of them have trended up, they've gone up sharply, and are factoring in significant positives already.
And should you look at IT differently at this point of time, Sandeep? You've seen a very decent rally from the lows. You're now, what, 20% higher from the lows. Should one consider IT even at this point? Should you stay away? How should one look at IT? Is there a pocket, maybe the smaller names that one should consider, or none at all?
So IT was always a trading kind of bet. So I think we had a move. I would think that we could still have some more move, but it's not a sector which we are looking at for the long term because uh, uh, on an average, next 2 years, the earning growth could be maybe 3 to 5% for most of the companies. So I think at some stage, if they reinvent themselves and go on a higher growth path, then we could look at them for the long term.
Okay, Sandeep, we'll let you go on that note. Thanks as always for joining in. Good chatting with you. Settling in.